Hey, everyone. I'm not hearing anybody.
I was
We're
on
here.
mute.
Can you hear us?
Admittedly, I was on mute, Gene. Can't hear you. Nope.
I think you're on mute, Gene.
I always feel like I'm a workday commercial.
I think she's talking to somebody, that's why.
Yeah.
No, she was trying to get in. She's having problems with her computer, so she's having to use her phone for the audio.
Can you hear us?
Now,
Yes.
You can hear us now? Yeah. Thank you. All right, so not so much great with the computers. Hello, everyone.
Let's see if we're gonna take roll call eventually.
man,
Okay, I'm trying to speak again, but it's clearly, oh, is it working now? Can you
It
hear me?
is.
Yes.
We can hear you,
Okay.
Gene.
Now, someone else speak, because I can't, that was my problem before, is I couldn't hear anyone.
Testing.
I'm having that same
Okay,
problem.
I have to call in also, so hang on.
I feel like this is the Brady Bunch.
mhm. Oh, laugh at.
Okay, so can people hear me now?
Yes.
Yes.
Sorry about that. It's what a mess. And we still don't have Rick, right? All right, well, we'll start without him, and if he joins us, that's awesome. And Vicky, you're running the meeting, right?
The video's on.
Okay, and the record?
I can't hear anything.
Nope, can't hear you, Gene.
Okay, so I guess I'm unclear as to where my sound is actually coming from, so we'll give it a shot here. All right. I'm gonna try and share the screen. Let's see if that works. Are you able to see my agenda?
Yeah, if you could just increase the screen, that would be good. You hit the, if you hit the
Maximize
block,
the-
if you hit the block next to the X, it will, yeah, there you go. That should maximize your, there you go.
Okay, so it is 3:09. And the first item was approval of the minutes of the special meeting from September 21st. Did everyone have an opportunity to review those? Were there any questions from committee members, Skip, Vicky, Holly?
Fine with me.
Okay, so we need to have a vote. Can I have a motion to approve?
So moved.
A second? All in favor?
Aye.
Okay. The next item on our agenda is updates from the chair, and I just wanted to do a quick note on committee appointments. There had been some confusion following the reappointment of Skip in January. All of our terms were listed as life terms at one point on the town website. That has been corrected. I did ask for some clarification. And just so everyone is clear, the town ordinance states that our terms are 3-year terms. So Skip is on for another 3 years. I believe Rick's is up in January, and mine will be up the following January of 2024. So we're a cycle through on that. I just wanted to clarify that because there had been a bunch of confusion among all the committees about some of the term issues. And I think it was just due to new software, to be honest. But just so everyone knows and understands that.
Jane, question?
Yeah. Yes.
Is Dave Kelsey still a member of the committee?
Yes, he is.
Okay.
And he had indicated he was coming as well. So I'm not sure what is up with he and Rick. So he's
Okay.
because of his position on the finance committee,
Okay.
not
Gotcha.
an appointed. Yeah.
Thank you.
Yeah. And I'm just going to see if either of them had sent me. Nope, I don't see anything. Need to share that part. How do I get back out of here? Sorry about that. I was trying to see if they had sent me an email. They couldn't get in, but I haven't gotten anything, so that's okay. All right, and then just a quick note: we did adopt the investment policy statement in late September, early October, so that is officially our IPS until we choose to amend it or adopt a new one. So that was a big step forward on our part, and I just wanted to remind everyone of that. And then just a reminder also that the stable value change in re-enrollment has happened. It did happen in early January, so that has also been accomplished. And I think we can thank our folks at Passy and T. Rowe Price for getting that through, and at least towards the end they're trying to make sure that all the participants knew about it, and those that chose not to make the change had the opportunity to elect not to roll over into the target date fund from the stable value. So any questions on any of that?
Jean, just obviously not to get into the details of that, but was there a fairly positive response to that option for folks, or would you say the majority of them stayed where they were?
Actually, I believe the majority transitioned, but there are still a number of folks who elected to remain in the, so it was elect to remain, or don't do nothing and you get changed. So there was a substantial number that did elect to remain, and so that I consider that a success in communication, so that folks who did want to remain did have the opportunity, and many did take that opportunity to make that choice. So, and I think
briefly touch on that. We have some visuals for that as well. Okay.
And so I think both the folks from PASI and TRO can shed a little more light on that. But yes, there was, I consider that a success. The fact that folks elected to remain means that they received the communication and made the choice. Not everyone probably did, but a good number did, and that I consider a success. So.
Yeah, and the only reason I raised that, Gene, is obviously with this group of folks, we always worry about our communications reaching them and actually getting recognized that they've been touched by their administrator or their committee. And it makes me feel good that we at least were successful in that. So people, that's good enough. Just helps me feel a little bit better on the communication side.
Right, I totally agree, Skip. And with that, I'm going to stop sharing and ask the folks at PASI to then provide us with their updates. And I think they may invite the folks from TRO to jump in on some of that as well. And just a quick note, some of you may remember Tom Reinhardt, who had been participating with us for quite some time from PASI. He's not with PASI anymore, but we do have some new folks, and I'm sure Ron Fishman will introduce them as we go along. So thanks.
Thank you, Jean. Appreciate it. And thanks for everybody who are here today to participate. Just in way of introduction, my name is Ron Fishman. I'm a principal at PASI Investments and PASI Administration. As you probably know, we're going to sort of go through an agenda. I kind of broke it down into 3 parts. We're going to show kind of our fiduciary standards of how, you know, for on behalf of the town and the plans, what PASI does as a fiduciary for that plan and the standards we go through. So we're going to present our fiduciary report. I also have with us today from PASI, I have Jeff Pangaro, who's in the red shirt, and right there, he's our senior portfolio manager. A lot of behind the scenes, you know, doing the evaluations and really overseeing this as well. And then we have Ashley Rendon, who's, you know, sort of the, I would say the replacement for Tom. You know, Ashley comes with a wealth of experience on the advisory side. She will be working with, you know, you all on education and really the day-to-day, you know, contact if any participants have questions. And again, our committee, you know, behind the scenes are always discussing this plan and making sure we're all on the same page. So in addition, we have some folks from TRO, Dan Matson, who's been on these calls before. Dan is the, you know, account relationship, you know, from TRO. So he's sort of the liaison between TRO and the committee and the plan. And given what Jean said about, you know, the target date reset, you know, it sort of dawned on me that since the majority of the assets have now migrated to the target date series managed by TRO, it would be nice to have more of a deeper dive from their product management side. So Alan Valencia is here, and I actually know Alan from many, many years ago, so it was nice to have him join us today. I was glad that he was able to jump in on a sort of short notice. So Alan will be kind of going over the, I think for committee purposes, really the product itself, what its purpose is, and sort of the deeper dive into the analytics of, you know, glide paths and all sorts of things of what this product provides to participants. And I think it was a great decision by the committee. As you know, when we inherited the plan, we didn't know how people really elected their investments. Many of them were in the, you know, stable value, fund, probably by default. Some sporadically had some, investments here and there on the equity side, but we didn't really have a grasp of how people really elected their investments. So we thought it was kind of a great opportunity to make sure they're well diversified, if you will, by age. And we can talk more about the target date series for those who want a little better understanding of how a target date works. So that's sort of where we're at. If Jean, you can allow me to share the screen, I can pull up our fiduciary report, and I'm crossing my fingers that you know how.
Vicki, do you know how? Because you're supposed to be the manager, and I don't have an option that says allow other participants to share.
I think I might have it already. Hold on. Okay.
Okay.
Yep.
You're good. You're good, Ron.
Perfect. All right. So you all can see this this presentation here. Everybody see it?
Yep.
Okay. If you don't have a copy of it, or Jean, I don't know if you've disseminated copies of this. If you haven't, we can make sure that, I think, Jean, you have this, but make sure that Jean passes it around for purposes of the committee for the records. But again, I think we've gone over this before. Part of our role, if I just had to sort of, getting through the history and the sort of services we provide, I kind of break this down into two parts. I just want to make sure the committee understands real briefly what PASSI's roles and responsibilities are. So if you don't mind, I'll just spend a minute or two. Part of our service is to administer the plans. You have two plans for the town. One is, from a technical standpoint, is a 401A plan, which is really what described as really the employer portion. When the town makes a contribution on behalf of the eligible participants, it goes into the 401A pension plan. And then you have what is called a 457B plan, which is really the participatory voluntary portion from the employees. So that's the side where if they want to elect a certain percentage of their pay, they can do that through the 457 plan. So part of our role, some of this is not applicable because you are a town, but part of our role is to make sure that both those plans are properly designed. We did a very deep dive a long time ago, probably before this committee, to make sure that we amended and restated the plan to meet the objectives of the town and make sure everything was in good order. So we're responsible for the plan documents. We're also, as it states, we help enrollment process. We do detailed participant level accounting. What does that mean? So your custodian, or the portal that you send your money to, is with T. Rowe Price, but annually what we do is we collect data from the town, and then we make sure that whatever was stated that of monies that went to T. Rowe, we account for, not only on a plan level, but on a detailed participant level, making sure that every dollar is accounted for. Because this is a not subject to ERISA, we don't have to file a 5500 for either plan. But again, we serve as a resource throughout the year, from the day-to-day, management, any questions, concerns about the plan eligibility, anything that goes on. We also coordinate distribution processing if a participant is eligible to receive a distribution. On the investment side, which is really where we're going to focus today, our job, I say the most important bullet item on this sheet of paper is PASSI is acting as a 338 fiduciary advisor, which means we're mitigating a lot of the liability from the committee. We're responsible for monitoring the investments, executing, changes, executing the decisions that you guys make, making sure that we're, identifying, any underperforming funds or whatever the investment policy statement says. We're following those guidelines, and we're executing those to the best of our knowledge and acting as a fiduciary for the best interest of the participants. We meet with the participants from time to time when we're able to, and I think that's part of our discussion today is, how well are we doing on that side, and what can we do how can we do it better? Skip, you said, communication is paramount to the town and to the teachers, so it's important that we execute some type of policy of how we're trying to educate the participants in the plan. So part of this analysis or presentation will be what we call the state of affairs page, which I'll get into. And Jeff and Ashley certainly can chime in from time to time if they have any comments on this. But I think we've spent some time on this reporting. This is FI 360. It's a software we use. It's a third-party software. You've heard the term Morningstar. It's a third-party analytics on all things mutual funds. They grade the mutual funds on a 1 to 5 star. This is sort of similar in the pension world. What this software does is it links to T. Rowe Price. So we're able to download all the information from T. Rowe's website, from the participant gatherings of all the assets, and pull it into our software. And it allows us to sort of present our fiduciary report. I call this the state of affairs. It gives a wealth of information based on that download as of 12/31. Okay, so what we're going to show you in this report really is based on your investment policy statement. So you all had a chance to look at the investment policy statement in the past. You've signed off on it, but and it's attached to this report. And we feel, again, the investment policy statement really is the blueprint to how we, deal with, the criteria of how we select funds, how we, monitor them, what constitutes a fund that goes on watch, what constitutes a fund that goes into replacement status. So it's really the crossroads between, how we process things, processes, procedures. What are we looking at? Again, it's the investment policy statement. Any questions so far? Pretty straightforward, right? Okay. So I want us to spend a few moments on this. The problem is, and that's what dawned on me, is this is a little outdated because even after 12/31, as you can see in the middle of this page under asset allocation, you have 3.9 million in equities. At the time, you had 453,000, in international type of investments. You had, taxable bonds, you had stable value, close to 2 million, et cetera, for a total of 12 million. We're talking about the 401(a) plan. But we did do a target date reset. And so really, this has all changed. So I didn't want to spend a lot of time on, looking in the rearview mirror. I wanted to kind of focus on the future because, as you know, the target date reset changed the positions of the investments dramatically. And I'll show you how that changed dramatically in a minute. But what this sort of backdrop tells you in the state of affairs is at the time, if you recall also, I'll focus on the weighted average. The weighted average expense ratio, which is really just taking the weighted average of all the funds where they are, and it gives us an expense, based on the funds that they're invested in. So 0.4 was the weighted average expense ratio. At one time, prior to that, we had done a project called sort of a revenue neutral approach. What we did was we stripped out all the retail funds and we went institutional. So that was a big dramatic change because if I did this report over a year ago, you would have been up around 0.85. So if you recall, the committee decided that we would go revenue neutral. T. Rowe Price came back with a record-keeping charge instead of taking it from the revenue share that was generated from the funds, and therefore we fall into a weighted average about 0.4. I would say that's extremely low cost. That's an institutional kind of expense that you would normally see in a plan of this size. So I think from a fiduciary standpoint, we did the right thing for the participants. IPS alignment warnings is basically saying in your investment policy statement, we listed the kind of the Morningstar categories that we felt we should have representation, by fund in each category. And all this is telling us is that we fulfilled that criteria of putting a fund in each category that's based on that's written in your investment policy. So we have 0 warnings on that. Weighted average fiduciary score, FI 360 fiduciary score. What that is giving us is a scale system from 0 to 100, 0 being the best actually in this case, and 100 being the worst. FI 360 has their set of criteria of how they grade or give a grading system to each fund that we've selected. within this plan. And we actually then in the investment policy statement, we actually layer it with an additional criteria, adding in certain performance figures, certain risk management, and so we call it a custom score. So the average weighted score for at FI 360 is giving us is 24 out of 100, pretty much a solid B plus, A minus, And again, that's based on the funds and where the funds are invested. Now that the target date reset happened, that weighted average FI 360 score would be pretty much a 0 because T. Rowe Price is in the top quartile of their by performance and all the criteria that FI 360 gives. So that score has changed dramatically by doing that alignment to the target dates. It also tells us that we have 2 funds on watch. What does that mean? So based on the investment policy statement criteria, the Fidelity Extended Market Index and the T. Rowe Price target date 2005 became on watch. Why? Again, it's based on certain criteria measurements that we have in the investment policy statement. It allows us then to interpret whether we decide, to replace or do something about it. And from a committee standpoint, the Fidelity Extended Market Index is not something we're, recommending to even attempt to replace. It's on watch right now. It's not saying it's a bad fund. It just didn't pass some of the criteria that we put in the investment policy statement. There's only $33,000 in that plan, in that fund, so not too concerned about that. And again, we're not recommending any changes to it. Okay? So that's sort of the state of affairs. And again, if you look at the target date reset, here's what happened since this report happened. So I'm going to pull up, share this screen with you. This is the 401A plan provided to us by T. Rowe Price. So as you can see, I can show you the whole thing. You can see a vast majority of the assets ranging from the 2005 to the 2065 lands in these targets.
Ron, we're still seeing the report.
I'm sorry?
We're still seeing the other report.
Sorry. Hold on one second. Bear with me one second.
All while Ron's pulling that up, apologies for being late. I had a client that passed last night.
Sorry to hear that, Rick. That's always a hard one.
Yeah.
Can you see this screen here?
Yes, we see it.
Okay. So again, as Jean mentioned in the beginning, we communicated with the participants. We worked with T. Rowe Price. We sent memos out. T. Rowe Price sent, their literature out, stating that as of a certain date in January, that we would do what is called a target date reset. And based on that memo, it gave the participants an opportunity to opt out of that target date reset. And as Jean mentioned, we must have communicated pretty well because there were some people that did that. So this is sort of where we landed. This is Dan, correct me if I'm wrong, this is a snapshot as of 2/28, I believe.
That's correct. And to answer Skip's question from earlier, around the people that actually did opt out or made a choice, there was 13 total participants that actually opted out of that reset in the 401A plan.
Yeah, so this is the 401A plan. I was just trying to do a balance. So, if I could just play around with this real quickly, you have roughly 10 million that ended up in the target date series out of a total of 11. So there were some opt-outs. A few people went back into the stable value, which is right up here. Some people went into some, fixed incomes on their own. Some chose some market, some equities, mid-cap values, things like that, dividend growth, blue chip. But for the most part, I would say we accomplished the mission of making sure that the participants are well suited by risk and age. And that was based on their birth dates. even gave a chart of where they would end up based on their what their birth date was. So so that's really what happened that was the 401A. And again, the same thing for the 457. I think it even, about 99% of the people stayed in the target date fund.
Ron, how long will you keep something on a watch list before you recommend removing it?
4 consecutive quarters.
Thanks.
Yeah, and again, that discussion became less relevant, especially when there's $0 in a particular fund if it was on watch. Again, we still have a really, really good lineup. Going back to, if I just bear with me, if I unshare this for a second, just giving you the let's get out of here for 1 minute. Go back to this report.
This is Jeff. I'll just comment on the Fidelity Fund after the reset. It's down to $400 that's in that fund, which would be one of the factors too.
Yep, thank you. Let me just share this one again, if I can just get back to my report. Share that.
While you're pulling that up, Ron, and maybe this is what you're getting at, but the smaller of the two plans, the 457 plan had only one person opt out of it. So majority of assets in the smaller plan are, 90, let's call it 95% of the money's in the retirement date funds.
That is correct. I was just trying to get back to my my holdings page. Again, it's the series of funds that we chose, which is a very well diversified portfolio ranging from all different asset managers. Again, it's a solid lineup. It gave a great FI 360 score. We're not recommending any changes. You've seen those funds before, and our job is to try to educate the participants going forward. But for the most part, they're in a very, very good performing target date managed by T. Rowe Price. So what I also wanted, maybe it's a good segue into letting Alan talk a little about, since 95% of the total assets are in a target date managed by T. Rowe, I thought it would be a good idea for Alan from the product side, representing T. Rowe Price, to maybe give an overview. He had a deck of about 60 pages, but I know he's not going to go through that. But if he can kind of walk you through the purpose of, how the target date was from a product standpoint, what its purpose was, some of the short-term, long-term effects of how things are going, I'll be glad to have Alan speak on those on behalf of that.
Thank you, Ron. And just trying to share my screen here while I'm waiting for that to come up. Excuse me, appreciate everyone allowing me to join the call here today, and appreciate your faith and confidence in T. Rowe Price. And as soon as I can share the screen, I promise, Ron, that I would not go through every single slide in the two decks, but I wanted to show one to really have kind of a four-part discussion. First 3 parts, I'm going to focus on our client book, as we call it, and really just was hoping to give you an overview of the franchise, the T. Rowe Price target date franchise, give you a little peek behind the curtain in terms of what goes into the product, share our philosophy on how we build and manage these products, talk about the 3 drivers of performance, and then lastly, flip over to the other slide deck, which is as of February 28th, and provide a little bit more up-to-date information in addition to the 12/31 data. So I am just seeing I've hit share, and it's allowed me to do that, but it's just spinning. Ron, were you able to distribute the two PDFs prior?
I did send the links to Jean. I'm not sure if she disseminated that to everybody, but I was hoping that you would just go through several, a few of the pages based on that.
Does everyone have those two PDFs by any chance? As I said, I'm watching this just kind of spin around, and I'm not sure if I'm making progress on sharing my screen or not, to be candid.
Jean, were you able to, did anyone get those links?
No, I barely had, and I could only get one of them to actually work, so I didn't send them out. But do you have them, Ron? Can you share them?
You're asking a lot from me today. Hold on. Bear with me. I'll give it a shot. Hold on. Alan, which one of the two? One was called Retirement Funds Client Book and one was called Target Date Strategy Update.
I'll tell you what, Ron, if you could go in the client book and go to slide number 7.
Okay, hold on. Let me give it a shot.
And as I say, while Ron's pulling that up, and I guess this is a good example of the age we live in nowadays. Can't go through a day without some type of technological issue on a Zoom call or a WebEx, as the case may be. So appreciate you bearing with us. As Ron pulls that up, I would share that T. Rowe Price is one of the oldest providers of the target date franchise out there. We got into the business back in 2002 after several years of some research, and that is ideal. Perfect. Thank you, Ron.
I'm just trying to find them. Yeah, so that's page 7. And let me just preface, the day that I could save a meeting with technology and pulling up that is a miracle itself. So happy to help.
I appreciate it, Ron. Multifaceted. So the point of this slide, and I'm not going to spend a lot of time thumping our chest here, but just want to give you a perspective on T. Rowe. We are a global $1.7 trillion money management firm. About 400 billion of that 1.7 trillion does sit in our target date franchise, which is around 23 cents on the dollar, are monies that we manage in these target date funds. So it enjoys a very prominent spot in our overall framework in terms of the different asset classes we manage. And within the target date franchise, you see a bunch of different names there along the left-hand side. And those basically represent about half a dozen to a few more different product sets that we do manage. The first one that you see there, our retirement strategies, is the big 800-pound gorilla on the porch. So about 350 billion of that 390 billion sits in our traditional or flagship product. That is the product that you all are investing in for your, or giving access to your participants to invest in. Ron, if you could go to the next slide, please.
Yeah, I will. And besides Rick and Jean, who obviously probably have the most knowledge of target date, is there anyone in the audience that just needs a general overview of what a target date is? We'd be happy to talk about that first.
Very, very briefly for those who might not be fully aware, a target date fund is simply an asset allocation model that migrates with age. So as a participant, you simply look at the number on the name of the vintage and line that up as close as you can with your retirement date. And effectively, the further away you are from that date, the more equity, the more stocks we're going to hold in that balanced fund for you. And the closer you get to that date and through that date, we'll be de-risking the fund and investing less of the portfolio in equities and stocks and investing more of those in bonds. So the portfolio, as you go through your lifetime glide path, as we call it, will get less risky, but it will always have some mix of stocks and bonds in the portfolio. Main thing, does that, anything you would add to that? Any questions on that?
No, and that's from a fiduciary standpoint why we chose the target date reset. The Department of Labor blesses it. From a fiduciary standpoint, ERISA, you name it, it's the best approach that we can take to make sure that they're properly allocated based on age and risk tolerance.
So in terms of just a third-party blessing, most people are familiar with Morningstar. Ron mentioned them earlier. They tend to be the purveyor of choice for many individual investors. And they have two different ratings. They have star ratings and analyst ratings. Star ratings are just quantitatively based, and they're looking back on past performance. And the analyst rating is more of a perspective looking forward in a kind of an Olympian, gold, silver, and bronze medalist. If you're neutral, then there's no real confidence that that portfolio is going to perform moving forward. And then whether you get scored a bronze, silver, or gold, that just indicates the conviction that Morningstar has that that particular fund or product will continue to outperform. Excuse me. So the target dates here are all 4- and 5-star rated individually, and more importantly, as a series, we are rated gold rated by Morningstar. They apply that rating based on 3 pillars. The investment process, the investment management, the folks who actually manage the portfolio, and then the overall parent, the firm that they work for. We're the only product, the only series out there that scores their highest grade on all 3 of those pillars. So just very brief, one chest pump. I won't dwell on that. If you can go, Ron, to slide number 10. Excuse me. Just look at the team a little bit on the next, actually, if you can go back one more slide.
Yep, sorry.
So what you'll see here, the pictures represent the 3 portfolio managers on the top. We have 3 portfolio specialists and a investment analyst underneath them. The 3 portfolio specialists, Wyatt is the head of our franchise. Kim and Andrew are his co-portfolio managers. They manage all of those products that I showed you in that page where we showed 390 billion with about half a dozen or more products. It is their job to implement the various design, tactical positioning, and oversee the overall trading of the portfolio, make sure that the allocations on a day-to-day basis are what we want them to be. You'll see 7 names underneath: portfolio analysis and implementation. Those are 7 folks who do nothing but trade and work on transition. So as we're making tactical decisions, as we're processing daily contributions and distributions on a pool of almost $400 billion, you can imagine there's a lot of money moving around. And to the extent that we can make that money movement efficient, we can add value in terms of performance. And that's really what those 7 folks are responsible for. If you go to the next page, Ron, you'll see about 27 different names and faces. These folks are our R&D team. This is, if not the largest, among the largest research and development team in the asset allocation space within the industry, comprised of 29 professionals. 21 have CFAs, PhDs, 15 have CFAs with chartered financial analysts, 21 have advanced degrees like PhDs, and on average, this group has about 9 years of experience. And down at the bottom, you can see a couple of the different topics that they tend to focus on, from cross-asset macro research, absolute return research, managing volatility, up at the top, strategic allocation, and life cycle modeling. All of these things are just different elements that go into the end product that we built for you. And the way I describe these folks, we keep them in a back room with no windows. We slide food under the door, and every couple quarters or so, we get all this research that comes back out telling us what we might want to consider. So a lot of firepower, a lot of intellectual and academic firepower goes into the design and structure of the product. Ron, if you go to slide 14, I'll talk to you a little bit about the philosophy and the reason that we built our products the way that we built them. I mentioned that we came out with the products back in 2002. that was a culmination of about 3 or 4 years of pretty in-depth research that we did. And these are 4 things that were true then and they remain true today. So on the upper left-hand side, you see that saving rates are oftentimes too low. Most professionals will tell you want to save about 15% of your salary to be able to put yourself on a track to have a successful retirement. And that's a total between employer and employee contributions. And as you see there, although in later years, some of the folks tend to get up to that level, particularly in the earlier years, where we're doing better now than we did 20 years ago, but it's still not enough. So people are under saving. Down on the lower left, life expectancy is rising from 2002 until last one I saw was 2019. We'd extended the life expectancy by 2 years. So people are living longer with all the advances we have in medicine, et cetera. On the upper right, retirement liabilities are growing faster than inflation. That we hear about inflation. We've heard a lot about inflation as a country here over the last 6 to 12 months. But historically, over the last several decades, you'll see that the inflation in retirement is actually higher than the inflation that the general public feels and talks about as expressed in CPI. So your dollars are not going as far as they used to, even more so in retirement years. And lastly, spending needs in retirement are uncertain. Emergencies always come up. Living here in the Northeast, we're familiar with the winters. You can get price shocks in retirement just as you can prior to retirement. So, you get a lot of snow one year, roof collapses, and all of a sudden you have to come up with some amount of money to replace that. So all these things are just research that we've done from that R&D group to just kind of try to quantify that and identify the exposure. Ron, if you go to the next slide, there's one other aspect of research that I would share, and that's the behavioral research that we see. And what you see here are 2 different populations. On the lower line, that dark blue and dotted line, that represents target date investors. The gray line are the do-it-yourself folks. Those are the folks that opted out of the re-enrollment that you recently did. So for what you see here, over the last 20 years, 15, 20 years since 2006, the dotted lines represent the average percent of change that a participant will make to their account at different points in time. In general, overall, over that entire period, we find that target date investors on average make about 0.6% changes per year in their investments. Your do-it-yourselfers tend to be much more active. On average, they're 4.5% at the same time. And what you see in those solid lines are really the actual numbers over time, and that's overlaid on top of those vertical gray shaded areas, which represent periods where the markets are 5% or more down during periods of stress. The one on the far right represents the coronavirus period. And what you saw during coronavirus at the depth of the first quarter of 2020, target date investors did spike. You see that little bump up there. They spiked from the average of 0.6 to about 1.5%. So what that tells us is 98.5% of participants investing in target dates remained in those target dates. The do-it-yourselfers, on the other hand, went from the 4.5% average to almost 10% who made a move. And I would expect and can share that most of those moves were not getting into buying more equity. They were probably selling out at a time they probably should not have sold out and locked in their losses. So that behavioral aspect of knowing that target date investors are sticky, they invest and they stay in these funds is very important for us as we build the product. Ron, if we could go to slide 16, please. So armed with all of that is sort of the backdrop. We have 3 drivers of performance. We have a goal-driven glide path. We have active management underneath the individual strategies that are the building blocks of the product. And then we also make dynamic tactical adjustments month to month, which are really just small incremental tilts one way or the other to either try to avoid areas of weakness or lean into areas of strength. So looking at the first one in terms of the goal-driven glide path, Ron, if you can go to page 20, the biggest risks that we find that participants face in retirement is longevity risk and inflation risk. The risk of outliving your money or having the value of your money, the buying power of that money reduced so far that you're unable to maintain your lifestyle. So when we designed our glide path, and all the glide path is just, I mentioned that early in the years we have more equity and later in the years we have less. The glide path is just that rolling down of that asset allocation from more stocks to fewer stocks over a lifetime. What we did here is we looked at the indexes that represent the design of our glide path, how much equity and how much bonds. And we looked at historically, if we had built a product reflecting our glide path, and we looked over every single 40-year period, every single 30-year period, every single 20 and 10-year period, what you see there are the percentage of those periods historically where that higher equity exposure, that design that we created did better than if you had just gone with the average target date allocation. So those dark blue lines, not only in the 30 and 40 year are we 100% of the time more able to create better outcomes for participants, give them more money at retirement, but you can see that on over 40 years, that is over $200,000 more in their retirement account. Over the 30-year period, it's maybe 150-ish or so. 20-year period, maybe about 60, 55, 60,000, somewhere in there. And over a 10-year period, the average is probably in the, call it $10,000, $15,000 excess return. And if you see on the 20 and the 10-year periods there, whereas we have 96.3% of the time we're able to outperform by that those dark blue amounts, those little slivers of gray represent the underperformance in those other periods. So for the 6.7% of the 20-year periods where we underperformed, the average amount of underperformance was, I don't even know let's call it 5,000, although it may not be that much. And similarly, over the 10-year period for the 18.9% of the periods where we underperformed that average allocation, again, call it maybe $5,000 to $7,000 underperformance versus $15,000, $20,000 in those other 80% of the instances. So again, trying to provide a vehicle that provides a lot of growth so that participants can kind of grow their way out of some of those behaviors, under saving, facing the headwinds of the higher inflation, et cetera. This is what, between this and that behavioral aspect of people staying in the account is what gives us the faith and the confidence to be able to manage the product the way we do. Ron, can you go to slide 23 and I'll talk about one other aspect here in terms of the structure of the product. So what you see here in orange represents sort of the equity allocation. So in the early years, 45 years before retirement, so think a 20-year-old, we're going to be 98% equity represented in orange and 2% in fixed income. And as you get closer to retirement, which is represented by that white line in the middle of that chart on the left, the vertical white line, that's your retirement age. And then post-retirement, we continue to go down for 30 years beyond retirement until we get to 30% equity and 70% fixed income. That 75-year period is really, just think of it as kind of a way, the scales of justice, where we're getting less and less equity over time, more and more fixed income. What you see on the right-hand side is a listing of the 24 underlying investment asset classes that we use underneath the hood. So there are 8 investment options under the fixed income sleeve and 16 options under the equity represented by orange there. So we have a very robust glide path design, both in terms of the amount of equity that we have, particularly in the early years, and then secondly, in terms of the robustness of the underlying diversification, rather than just putting everything in an S&P and the fixed income in a U.S. government bond index or something. we're trying to provide ourselves with exposure to multiple areas of the market to diversify and absorb different shocks over time. As you look at how we've done in terms of actively managing those areas, Ron, if you could go to the next slide. There we go. This is over time, over rolling 3, 5, and 10-year periods. 3 year is, if you look at the rainbow at the top there, 3 years the dark blue, 5 years the aqua, 10 years the gray. What we're showing here is the aggregate value add that that we're generating from our active management of all of those 24 underlying sleeves. And what percentage of the rolling 3, 5, and 10-year periods are we adding more value than if you had just invested in the index? So we see here 75%, 80%, and 94% of the 3, 5, and 10-year periods we're adding value. And down below in those orange bars, you can see that we generally average about 33 to 35 basis points, or 0.33% to 0.35% annually from that active management. Ron, if you could go to slide 25, please.
Alan, as I'm doing that, can you maybe just in concept talk about the difference between the target date to or through, versus through, and what your philosophy is on TRO?
Yeah, so to and through, if you could stop on 25 there, Ron, please. Thank you. The to and through really just describes what the glide path looks like. So if you think back to that slide I showed you a few moments ago, or on this slide, if you look at under the asset class, you see a similar glide path there. A to glide path basically stops de-risking once they hit that retirement age. It just goes flat line from that point to the right-hand side. They hold the equity, the exposure between equity and fixed income steady from that point forward. We believe at T. Rowe Price that it's wise. People naturally on their own continue to de-risk or take lower risks after retirement. So we believe in a through glide path. Each and every one of our products does have a glide path that continues to draw down stocks and increase that fixed income exposure post-retirement under what's known as a through type of glide path. Does that answer the question, Ron?
Yeah, that does. I just wanted to make sure that, again, in part of our fiduciary roles is we do kind of analyze, do we go with a through or to? And I think that's an important concept. I mean, we at PASI also agree that the through concept is that most people, at retirement or whatever target date they chose isn't just going to stop de-risking. They're going to probably keep the money in the plan beyond retirement. And should they do that, we want the continuation of the de-risk going on, through that target date. Again, I don't know how they accelerate that through, but that's I don't know if you want to comment that, but we do believe that as they go through the target date, 2040, 2045, whatever it is, it's very important that they continue to de-risk over time.
Yeah, and I think the market has spoken on that too. If you look at all the assets that sit in these target date products, so about 10 out of $11 sit in products that have a through glide path, not a to glide path. So, I mean, I think there's clearly a preference that individual investors have, whether it's expressed through that statistic, or if you look at their own allocation by age for those do-it-yourselfers, you see a similar type of lowering of equity exposure as you get older. So I talked about the robust glide path design and the design of the underlying active management. I just shared the active management in practice, what that's been able to add to the equation for us. And the third driver of performance is tactical asset allocation. And all this refers to is when we build these products, we have a long-term objective structure that gives us a neutral target allocation to each of those 24 individual building blocks underneath the glide path hood. We meet monthly to talk about the markets and what's going on. And we've been doing this since 1990 at T. Rowe Price, and that's represented in the lower left-hand box here. We have an asset allocation committee that gets together and looks at things from a 6 to an 18-month view. And they're trying to identify things based on a relative value type of perspective and identify where we want to be tilting the portfolio. And we're not making big bets. We typically are moving in 25 or say 0.25%, 0.5% increments. But what this slide shows you is at the glide path level, that first thing at the top where it says asset class, you can see that we can go plus or minus 5% off of that glide path I described. So when we're from 98 down to 30% across that entire glide path, we can adjust that by plus or minus 5% at any point in time. Inside each of the two equity and fixed income sleeves, as we call them, we can deviate those allocations by plus or minus 10% within each of the sleeves as well. And we're doing this each and every month to try to, again, either mitigate risk as we see volatility and/or in more of a risk-on environment, maybe lean into some opportunities. Ron, if you can go to the next slide, I'll show you a similar slide, and this breaks out what value add we've been able to add through these moves collectively. And it's the same structure. The rainbow chart at the top shows you the rolling 3, 5, and 10 year, and in the orange, it shows you the average value add that we've added to the portfolio in terms of basis points, which is around 12 or 13 basis points over 3, 5, and 10 year. And we do add value of 70, 72, 83, and 100% if I'm seeing that middle one correctly. So in total, we're adding about 0.5% of return annualized over the longer term periods of time. Ron, if you can go to slide 27, what I would say is 0.5% doesn't sound like a lot, but in reality, it really is. This shows you over a career what 0.5% higher return can do for a participant in terms of their retirement. On the left-hand side in the lower left, you can see the assumptions, 25-year-old making $30,000, getting a 3% raise over time, contributing 9% to their 401k over time, or 457 as the case may be. Retiring at age 65 when that $30,000 salary has grown to be about $97,000, $98,000. And what we're showing here are 3 scenarios. One where we have earned 7% pre-retirement and 5% post-retirement. And then on the far right, I'm going to skip the middle one. I'm just going to go to the 50 basis points and say if we're able to add 50 basis points, 0.5%, so we go from 7 to 7.5 pre-retirement return and 5 to 5.5 post-retirement return, what will that do in terms of taking money out of the plan? What does that do to the outcome? And the assumption here is that we're going to take 50% of the ending income as a retirement income. So if we had $98,000 as the ending salary, we're going to take about $46,000 out of the account annually beginning at age 65 and grow that 3% per year. And what you see there is that extra 0.5% actually on the right-hand side can add an additional 2 to 5 years, depending on the structure that you look at there. So being able to have money last to age 92 instead of 86 is a meaningful difference, and that's just 0.5% increase in performance. So that we think that we've been able to build a product that really does meet those needs and help people meet their longevity and inflation risk that they face in retirement. And if I can give you some performance information here before we close up, Ron, if you can go to the other deck.
You think so?
You know what, Alan, I just want to take a minute to say that we definitely appreciate the detail here, but I do want to make sure that we respect people's time and that we do have time to discuss participant meetings and communications, which I think is a critical factor. So maybe if we could review those, I will share the information with the rest of the committee members, and if there are additional questions, we can reach out separately. Would that
Sure.
meet everyone.
That's fine. That's fine.
So Ron, did you want to talk about plans to communicate with participants and hope to schedule meetings, which we all want to have happen? Last year, it wasn't overly successful for a lot of reasons, and we could hope it would be more successful this year.
I think it's always the challenge, especially in a pandemic world, is how you communicate. We can put the best lineup together. Again, I think we did a great, justice to the participants by properly allocating them into some very, very good managed target date funds. So I'm confident that from that perspective, anyone who did not opt out is well positioned from a risk reward standpoint. But you're right, communication, education is paramount to, making sure that the participants not only understand the investments, but what's the benefit of this plan? How much is the town putting in as an employer contribution? How much, what is my opportunity to defer my income through the 457? Those are important aspects. So yes, we've had some challenges. We don't have the luxury of calling, sitting, in a room lately, calling a town meeting. We have the challenges of schedules for the teachers, for the when we're talking about the 401A. So really, we try to establish, as much as we establish an investment policy statement, we always try to establish an educational policy statement. And that's really a combination of how you guys feel, the effort should be, whether it's quarterly, semi-annually, and what kind of communications and education can we provide. We do rely on our record keepers, such as a T. Rowe Price, to help us with collateral material. They have ways to disseminate information because they are the record keeper. They do have, the information on emails and addresses and things like that. We have our own collateral material that, we certainly like to provide in these type of meetings. The biggest one right now is how do you kind of manage volatility in the markets and what do you do about it? So we have some really good material on that. But the question really comes down to, and Nicole knows this as well, is how do we get in front of people? What's the best way? We tried this last time with the town and with the teachers, and it was, I would say, less than stellar as far as the participation in those meetings. Ashley was with us as well. She, that's her job as well, to help mitigate or manage the kind of opportunities and some of the topics that we can go over. But again, it's who's our audience and how do we get them to the table. I don't have an easy answer for you on that. We're at a point where we can do in-house meetings. I don't know if T. Rowe Price can do that, can do those yet. But I'm looking for guidance from the committee as well to suggest any opportunities that we can help, with the educational policy statement.
As far as the schools go, who do you contact to schedule on-site educational sessions at the school at the schools?
There's the hand right there.
Okay. And then how about for the 457?
So the 457, so 457 is just for the town, and the 401A is for both the town and the school district. Okay. So,
right. So who do you coordinate education meetings with for non-school participants?
Well, there's a couple of people. I think one of them, Nicole, you've helped coordinate that. So we've had, again, there's two, I think, two people we look for at the town to help disseminate, those meeting times as well.
All right. So I would propose to the committee that, we've gone back and forth on this. We understand the challenges that COVID presented. However, barring any real change, hopefully those have passed. And I think we should, as a committee, expect that there are proactively at least two educational meetings set up for participants on both the school and the town employee side on an annual basis. I think that's a very reasonable and doable request. I don't think it should fall on this committee to organize that and orchestrate that. I think that should fall on PASI to make sure that you get that done. That's my recommendation. I'll leave it at that for the board to make comment on, for the committee to make comment on.
I'll just say, Rick, that is not an unreasonable request. It absolutely is certainly something we would do. Anyways, I mean, annually is very reasonable. We would even suggest if we can do semi-annual. That's what we would do.
Even better.
Yep.
The key for us on the committee level is that we make sure that the education is offered from a fiduciary coverage standpoint. That's the critical metric. How many people participate or attend is, we would like them to be well attended. However, the critical metric is that we are ensuring that the education is offered.
Yeah. And again, that comes in many flavors. Again, we always look to our record keepers to kind of assist with that. Dan, if you want to make a few comments on your experience with, how T. Rowe Price is geared for, educating employees, whether it's with their advisor, without their advisor, whether it's through an email system, whatever. Why don't you maybe jump in for a little bit of that?
Yeah, thank you. So first and foremost, we are traveling again. Our teams are traveling. We've got regional education reps around the area, so we can certainly do meetings in tandem with PASI or even standalone as well. So we can, try to drip on the employees more than even semi-annual. We can do group meetings, virtual sessions, one-on-ones. Obviously, our one-on-ones are a little different than what PASI can provide. But a lot of times, a one-on-one from our reps would just be helping people log into their accounts, check balances, pay beneficiaries, things like that, which is all beneficial stuff as well. Use the tools online. Also, we do, as the record keeper, we do send out messaging to the participants through our Retire with Confidence program. So, our platform, if you will, gets to know the participants in the plan and sends out different types of messaging, whether it's via email, direct mailers go out. We try to put messaging on the website, on the app, etc. So we have a nice look forward piece that I can certainly send out afterwards that just shows how we're going to be trying to communicate with your participants this year and the different ways we do that. To Ron's point, we have very many different ways of doing that. And then lastly, I don't know if this is an option as well, we have a plethora of education content in our library that I can certainly email if that's something you guys think you can disseminate to, town employees. I don't know if that's an easy, email or, payroll stuff or something like that, but we do have a very deep bench on that front as well. So quite a few different options.
So committee, I'm proposing that we ask for an education, ongoing education proposal from both PASI and T. Rowe Price, where they provide us a recommendation of what it would be, how it would be delivered over the next 6 to 12 months. That my recommendation is that we ask them to come back to us with that. I think we've discussed this ad nauseum, and we're past COVID, and we should have a formalized structure that we expect them to execute on. And that may be a combination of everything that's just been mentioned here. But we should have a formalized structure, that is executed on and reported back to us that it's been executed on at our subsequent meetings.
Okay, I think that's a fair request. Again, I could have sort of label it as an educational policy statement. Let's put something together. It doesn't have to be drilled down to the specific topics, but I think we can get general on the areas that we want to focus on, the timing of that. We do have a challenge of school versus town, different schedules. Obviously, summertime is not good for the school, versus versus the town. So yes, we can put an outline together for the committee. I'll sort of have Gene as the lead on that to disseminate it. And then maybe, I don't know what the next meeting is, but we don't have to do it by meeting. We can maybe get your feedback on our first draft of the policy, educational policy statement that we put together.
Is that okay to all committee members? I don't want to speak for the committee, but I'm just trying to move this forward.
Well,
Right,
Rick, I
Rick?
think you,
I definitely agree, and I think we should expect that, and we should see it soon rather than waiting for our next meeting, because I'd like to see there be some education. Our next meeting's not going to be till September. I'd like to see there be some participant communication and educational activities this spring and summer. I think that is not unreasonable.
Not at all. So yeah, we don't need a meeting to kind of disseminate that policy and then get your feedback and then, put some time frames. Obviously, we got to look for to some of you folks, Nicole, as well as the school district, to say what's the timing of this. I mean, one-on-ones are very simple. That could be done anytime. But again, our experience with the one-on-ones did not go well. When we mention one-on-ones, what we do is we send out a sign-up sheet, and they fill in slots of time, 15-minute, 20-minute intervals, and that's our opportunity to whether we're in person or on Zoom, is to pull up their actual account and then to get into details about specifically what they have concerns or questions on. In a group setting, obviously we have to generalize. We can't be specific to some of their personal needs and requests. So I think it's a combination of working with TRO on some collateral material. It's a combination of one-on-ones, which I always strongly recommend, as well as some group presentations. Ashley, has experience in maybe doing some of these seminars or sit-downs, as well. So let us take a shot at, again, formalizing more of what I'll call the educational policy statement, and have your feedback on that.
and Rick, just to add to what you were saying, you missed it at the beginning of the meeting, but one of the comments I made was the fact that during the reset, there was good participation. So obviously that communication did work and get through to people, so that folks, responded, and the majority of them did go with the reset, and some opted to stay where they were. So we know it can work with the right message. One of the things that I remember Vicky saying early on is somehow, at least from the town perspective, if we can do this during work hours, like a lunch hour, or like a lunch and learn or something, where you're drawing people in with like free sandwiches, free food, and you set it up in the town hall meeting room, that certainly would accommodate everybody that is participating easily. And, you make it as attractive as possible, and it wouldn't break the bank in terms of doing that. And I think that's really what you need to do. You need to put a date out there far enough that folks can plan for it. And you say it's during lunch, you get free lunch. Yeah, we'll sit there and we'll have a high level discussion. And then at that point, you can say, those that have more detailed questions and want to do a one-on-one, please see us after, and we'll get you set up for that.
Yeah, it's absolutely what we do. Yeah, you're right on target.
Okay, well, it sounds like we have a plan for moving forward on that, which is great. And the only other item on my agenda was just to set the next meeting date, which I've proposed to be really 6 months, Tuesday, September 20th. If anyone has any concerns with that date, let me know. Does 3 o'clock still work for folks? And I know I like the WebEx, but if people want to shift to in person, we can contemplate that. But honestly, I'm not sure it's necessary for our committee. What are people's thoughts?
I second everything you said.
Good with
That
that.
date
I'm
works for
fine
me.
with that.
In person or not in person?
WebEx.
Okay.
Any discussion? Anybody else have a different opinion? I'll support whatever the committee wants to do.
All right, well, it looks
that-
like no one else has
Is that a so
has
moved?
anything.
Yeah, I'm second, third it, fourth it, let's vote.
Okay, any other concerns, questions that people have, comments before we adjourn?
I guess the only other thing is we should make as an item for the next meeting just to revisit those watch list funds to see where they are if any decision has to be made.
Absolutely.
Gene, Tim here, we might consider a meeting in two halves because, speaking for the town hall people, we try to keep the offices open. So if we could have, maybe if it's going to be a half-hour meeting, say, we could do it in two segments or 45-minute meeting, so we can still have the place manned. Otherwise, we have to lock the doors.
Okay. Well, we can certainly work to shorten or split the meeting. That's fine. All right. Well, if there's no other
The only thing I
questions,
would add, when we do those meetings, I would prepare, and this is really for Ron's benefit, I would have like a simple, question and answer handout. People like to take away something, and it's, simple, summary of what you're presenting that day. I think that'll be important for them to have a little simple thing that they can have, and they can go home and study and have the questions and so forth. And, like I said, you throw a lunch in it. That's what we kind of do. We call them lunch and learns, or there's all kinds of different things. They're pretty effective.
Oh, I totally agree. And again, we try not to make it just about investments. We try to get, if there is such a thing, with mileage for the town of the job they're doing and the contribution levels that they're providing. We like to talk about, the nuances of whether they should contribute on their own. So there's lots of things that we can discuss that isn't just, investment related that sometimes turns people off because, look, when we do our one-on-ones, the biggest questions that come up are, am I properly, is this the right investment for me? And do I have enough to retire? So it's usually the two main topics. But there's lots of things we can sprinkle in there that will make it effective. And I do agree that they can have a takeaway, on some items to think about, at home. So, and sometimes even if you do it, sometimes the spouse, sometimes it's a joint effort because they like to do that together as well.
Thank you.
okay. Well, if there's nothing else, can I have a motion to adjourn?
So moved.
All right. I guess we're all set, and we'll regroup. And I will send out what I have from the T. Rowe Price presentation so folks can look at that more closely if they'd like to. And Vicki, I think you can stop recording. And we are adjourned. So thank you all for coming. Appreciate it.
Thank you.
Thanks, everybody.
Appreciate it.
Thank you. Bye now.